What's up guys, it's Humphrey. Welcome back to my channel. I hope everyone is having a refreshing new year and hopefully 2021 is where we can get back to normal. As 2020 drew to an end, I got a lot of questions from you guys about what types of investments that we should be looking at. Should I invest in X, where X seemed to range from everything from safe stocks to growth stocks to speculative investments like Bitcoin and even Pokemon cards. And that got me really thinking. A lot of these stocks and speculative investments have been going crazy lately. For example, Bitcoin was at a low of 4.9K per Bitcoin back in March, and today it's trading at over 5 times that. I can start to understand why some people start to think that they're missing out on some sort of investment or some crazy opportunity. So today I want to share my thoughts about investing in general, my thoughts on money, and why I in particular hate losing money. Now, hating to lose money might not be the best attitude to have when it comes to investing, but even Warren Buffett doesn't even like losing money. Warren Buffett has even said himself that there are 2 rules that he follows. Rule number 1, don't lose money, and rule number 2, don't forget about rule number 1. For him, he believes that if a business could ultimately fail, then he's not interested in even investing in that company, and I tend to agree with his viewpoint. I want to show you guys something when it comes to losing money with investments in particular. Let's say you invest in 1 share of a stock and it's trading for $100 a share, but after some period of time that you actually own it, it actually starts to trade for a lot lower. Maybe it has a bad earnings report and all of a sudden the stock price goes to $67 a share. Your investment just lost 33%, so you think to yourself, okay, if it went down 33%, all I need to do is have the stock go up 33% to break even on my investment. But that's where you're actually wrong, because a 33% increase from $67 a share is actually only 89.11. To actually get back to break even of $100 a share, you need a 50% increase in the stock price from $67 a share. So that's pretty crazy, because the larger your losses are, the larger of a return you need to recover from that loss. A share price drop of 10% requires 11% to recover. A share price drop of 25%, for example, requires a 33% gain to recover. So this actually presents quite a bit of a problem, and it's something that people often forget when they're investing. So in this case, I would actually argue it's a lot easier to make consistent amounts of money over and over again rather than go through huge volatile swings. Now, there is a counter argument that is worth noting. The stock market tends to appreciate and actually can appreciate to infinity, versus the most that an investment can actually lose is 100%. The other argument that tends to counter my original line of thinking about not losing money is that you can actually rebalance your portfolio to recoup losses even faster. For example, if you have a $100 investment and you lose 50% of that investment, you're left with $50. Now what you can do is you can sell some of your other sectors in your portfolio and add to that position where you just lost $50. You can bolster it back to $100, and then all of a sudden you just need another 50% gain to basically break even. Still, even with this counter argument logic, I would actually argue that most people that lose money in investments or lose money in the stock market have a harder time dealing with it mentally, and that includes myself. Even though logic tells me that you should probably rebalance your portfolio or that stocks tend to appreciate in the long term, I find that I have a harder time actually dealing with that, and I find that other people do as well. It's something that we're all kind of afraid to admit, but emotions actually drive a lot of investment decisions and sometimes can get the better of your own logic. We're all human here. Obviously, we're not robots. It's hard to be completely 100% objective when it comes to investments. Obviously, you want to be as objective as you can possibly be, but there's always going to be some sort of emotions involved, at least in my opinion. Now, there's a theory called prospect theory, which actually states that the pain of a loss is a greater motivator than the reward of a gain. In fact, according to research, people react more strongly to the pain that comes with loss than they do the pleasure that comes with an equal gain. Now, this is certainly true for me. It's the reason why I don't actually like gambling either, and maybe you could call it a flaw, but for me, it just guides my investment decisions. I would much rather have small gains consistently over time rather than just ride a roller coaster of volatility or something like gambling. I know that everyone is different in this regard. It actually could limit my upside when it comes to investing, but I find that it's a much more mentally smooth way for me to operate my life. Now, here's another point I want to make about money in general and not losing it, or actually saving money. Saving $100 and not losing it is actually easier than making $100, and let me show you guys exactly why. Let's say you make $75,000 a year and you reside in San Francisco. The taxes are a little bit higher in California, so bear with me on this example here, but let's say you make $75,000 a year. You can see that the income taxes breakdown is actually quite high. Federal is 22%. FICA is 7.65%, and state income tax is 9.3%. After taxes, your $75,000 a year income is actually going to be closer to $56,000 net out the door. Basically, nearly 25% of your gross income goes to taxes, so to actually break even and make net $100, you actually need to make $131 in gross income. So essentially with taxes, no matter where you go, you need to make more than whatever you're trying to save just to break even on that transaction, or basically to offset your taxes. And it's even worse if you're self-employed. You got to add some self-employment tax there. But basically the point I'm trying to make is that it's much easier to save $100 than it is to make $100. So we should always kind of operate with this maxim. So this is one of the reasons why I like to go with investments that are a little bit safer, such as index funds, dividend stocks, and bigger companies like Apple. I want the companies that I invest in to be so big that they literally cannot fail within the next 50 to 100 years, and I want that stability. In my opinion, having compound returns and not losing that much money is just going to build my confidence, increase my mental clarity, and allow me to make more money in the future. It's also why I like getting rid of debt as soon as possible, because debt really actually costs you money. If your credit card interest rate is 20% and you have a balance that you owe on that, well, basically that's costing you a guaranteed 20% on your money. So by paying off your credit card, it's like you're getting a free 20% or a guaranteed 20% return on your investment. So does this mean that I'm never going to invest in a speculative investment? No, that's not the case either. You'll see me talking about Bitcoin sometimes and Ethereum because I will take a small percentage of my overall portfolio, let's say 5% out of my entire portfolio, and I'll dedicate that to speculative investments every single year. I'm certainly aware of the risks before I actually invest money into them, but in the event that they do actually hit and do very well, it's going to bring up my overall portfolio return. In the event that they actually fail, and let's say I lose my entire 5% in that speculative investment, I'm going to be still okay because I have 95% of my other portfolio still doing just fine. The key here again is diversification, and being as diversified as possible is going to make us the better investor. If you're interested in seeing what's in my portfolio, I would say consider checking out my Patreon. I give you access to my portfolio, and anytime I buy or sell shares, I let you guys know. We're also creating a model that pulls in Capital IQ stock data and screens them against value investing principles to suggest 5 or 10 different types of shares or stocks or companies that you should be looking at every single month. Let me know in the comments what you guys think of my investment style. Am I too risk averse? Are you guys more conservative than I am? Are you guys really aggressive? Are you guys like a James Bond type of risk taker? I don't know. Let me know. Make sure to drop a like on this video and subscribe to my channel if you haven't already. I make videos on personal finance and investing here on YouTube, and sometimes I share my thoughts like these. If you'd like a free stock from Robinhood whenever you deposit any amount of money, it could even just be $1. The link for that is in my description below. Lastly, thanks to all my existing Patreon supporters. I will see you guys in the next video, and the models should be out for those stock screens very shortly. Peace.